When hackers freeze a corporate database with ransomware, they don't demand terabytes of alternative storage in return. They demand cash. The phrase, data is an asset, has moved past theoretical tech speak. It is a concrete market reality driving corporate monetization strategies worldwide. Regulators are acting on this reality. Authorities like the Comptroller and Auditor General have explicitly instructed public sector auditors to reflect the fair value of data assets in their formal reports. This creates an immediate problem for chief data officers and IT auditors. They are now legally required to prove the exact financial value of an entirely intangible resource. Assigning a rough theoretical price tag to a user database might work for a startup pitch deck, but it is wholly insufficient to pass a rigorous regulatory audit. We all understand traditional financial accounting. Cash flow statements and annual revenue reports give us universally accepted tools to track physical capital and operating expenses. This split-screen diagram illustrates the structural void in modern accounting. On the left, a standard corporate balance sheet is perfectly designed to categorize physical assets, like fiat cash and real estate. Yet on the right, when we try to map digital database architecture onto this exact same framework, we hit a completely blank, uncategorized space. You cannot simply write customer data into an asset column. Holding data carries massive active risks, and traditional ledgers offer no mechanism to account for the burdens associated with storing it. To satisfy evolving privacy frameworks like the DPDPA and DGPSI, organizations must engineer a completely new, dedicated data balance sheet. Defensible data valuation requires a dual-entry accounting model that captures the mathematical relationship between utility and risk. This T-account ledger maps abstract data governance onto financial structures. On the left, data assets are quantifiable, operational benefits occurring directly to the data fiduciary. Drivers of this value include active monetization, proprietary algorithms, and internal operational utility. Like physical inventory, this value is highly sensitive to time. Data decays as it ages, or it appreciates based on shifting market contexts. Therefore, this side of the ledger reflects a notional value captured as a snapshot on a very specific day, mirroring the temporal exactness of a traditional balance sheet. These fiduciary assets represent gross revenue potential. But gross potential is an incomplete picture of total net worth until we account for what the organization owes. This brings us to the opposing side of the ledger. A core principle in the theory of data is that possessing digital assets unavoidably generates debt. These non-negotiable data liabilities are owed directly to the individuals who generated the information, the data principals. Under frameworks like the DPDPA, these obligations take specific forms. First is the continuous operational cost of consent management, tracking exactly what a user agreed to at scale. Second is the heavy architectural cost of maintaining active privacy protection measures, ensuring that data is insulated from unauthorized internal access. Third is the perpetual mandate of providing absolute security guarantees against external breaches. Every additional record stored directly increases the attack surface. Simply hoarding massive databases does not linearly increase a company's value. It simultaneously and exponentially scales their regulatory and security debt. Modern data architectures present a critical complication. Organizations rarely hold all their data internally. They rely heavily on third-party vendors and cloud providers. How do we categorize these external data processors on a balance sheet? Are they direct liabilities? Financial accounting offers a specific tool for this, a contra item. A contra account carries a balance opposite to its normal category, specifically used to reduce the value of a related account. We map the third-party processor onto the data balance sheet as this exact type of deduction. External processors introduce uncontrollable risk and compliance dependencies. This deduction mathematically reflects the immediate loss of direct control over the data the moment it is handed to an external vendor. Categorizing processors as contra items is essential. It prevents artificially inflating a data asset's fair value while keeping vendor risk hidden off the books. With assets and liabilities defined, we reach the final mathematical step, resolving the ledger to determine net equity. But there is a problem of proof. Auditors won't simply take a CDO's word that massive liabilities are safely managed. This is where we introduce the crucial metric bridging the gap. The calculated net equity transforms into the data trust score. The DTS functions as a single, highly synthesized quantitative indicator of an organization's overall compliance health. A high data trust score proves to a government auditor that the principal liabilities are fully funded and actively managed, which in turn mathematically validates the net worth of the fiduciary assets. The DTS is the ultimate translation layer. It turns abstract legal obligations into a concrete financial auditing reality. This diagram shows that while the theoretical framework of the data balance sheet is universal, the specific mathematical weightings are not one size fits all. Focus specifically on the healthcare sector's ledger. Healthcare inherently carries disproportionate principal liabilities because it handles highly sensitive medical records. The extreme privacy risks heavily outweigh the baseline operational assets. This profile sharply contrasts with the banking and financial services sector, which deals with entirely different variables, like high monetization velocity and severe fraud risks. And both of those differ entirely from the education sector, where the balance sheet is dominated by the complex liabilities of minor consent. Because of these differences, DGPSI frameworks are currently being actively branched to address these specific, highly nuanced sector variables. To achieve true fair value, each industry must develop bespoke valuation algorithms calibrated to their specific regulatory liability profile. Accurate data valuation demands the same strict discipline used in professional financial accounting. An organization cannot legitimately claim the financial benefits of a data fiduciary without rigorously auditing the liabilities owed to the data principal. As this specific accounting framework becomes standardized across the enterprise landscape, it will drive the imminent evolution of the broader theory of data. The data balance sheet creates the necessary link between digital compliance obligations and corporate financial records.